this video, we're going to talk about periodic inventory. In the next video, we'll talk about perpetual using the same information. You can either take a screenshot of this, write it down on a piece of paper, pause the video to write it down, but I would encourage you to work through this problem yourself so you make sure you have it. If you do use your handout, if you have a handout with it on it, I will warn you that I believe I typed 560 in there instead of 510. Instead of redoing this entire thing, I think I'll just have you change your handout to 510 because I ended up doing the wrong number. So anyway, basically we started out with 400 units at 20. We purchased 1,600 more at 25 each. We purchased 400 at $30 each. Look at the dates, the 1st, the 12th, the 28th. And then we sold some on the 10th and sold some on the 20th. The selling price is $38. So if you look here, I did this simply because it's going to work the same for all three methods, FIFO, LIFO, and average costing. But I simply put the inventory here, beginning 400 at 20, 620 at 25, 400 at 30, and over here the selling prices, and I extended them out. This is somewhat useful for periodic inventory especially. I took beginning inventory of 400, so I did a cost of goods sold statement. Beginning inventory plus purchases equals available, minus ending inventory is cost of goods sold. And so I started with 400 at 20, so I have 8,000, and then I purchased an additional 1,000, so I just added these two numbers together and added these two numbers together to get to 27,000. And so I have 1,400 units of inventory available that cost me 35,000. What I'm going to determine, which will differ under each method, are these two boxes right here, the ending inventory and the cost of goods sold. Okay? All three methods are going to have the entry for accounts receivable sales. So I sold on the 10th, 11,400, and on the 20th, 22,420. So we will both have that under FIFO, LIFO, and average costing. And we'll also have the purchases entry of inventory and accounts payable for 15,000 and 12,000. Notice this was beginning inventory, not a purchase, so that's just carrying over from last month. So first, let's go through the periodic FIFO. So under FIFO, basically it's first in, first out. So what I do under periodic is I just simply count my ending inventory, which is 510. So again, please make sure you change this from 560 to 510 if you have the wrong number on a handout. And so it means I sold 890. So what I do is ignore these sales. I'm going to have this accounts receivable sales entry, but I'm not necessarily going to record the cost of goods sold inventory at the end. So I simply go through my layers as if I pretend all the sales are happening at the end. So first in, first out, I have my little computation. So I sold 890 again. How did I do that? Available of 1,400. I sold 510. I'm sorry, I have 510 left, so that means I sold 890. So I usually start by putting 890 in this box and total it up. Then I have 400, I work through my layers. I sold 890, remember, so I need 400 at 20, first in, first out, so I sold all of these. And then I need 890, so I have 490 of the next layer. So I just have my Excel spreadsheet set up so it'll add and subtract for me. So the $20 ones, I sold 400, I have 0 left for ending inventory. Of the $600 ones, I sold 490 because I need to sell 890. And then 600 minus 490 is 110 of the $25 ones. And of the $400 ones, you don't necessarily need to put this in here like this. I just did it for the Excel worksheet so I could change my numbers for FIFO and LIFO, or for LIFO, and have it do it automatically. So I have all 400 of the $30 ones. So notice my ending inventory is 510 and the cost is 14,750. I will have a check figure. So notice if I add my cost of goods sold is $20,250, and I have my, I'm sorry, I go over here, $20,250, and I add my inventory. That ought to add up to $35,000 available. Another way I could get cost of the goods sold or ending inventory is I could compute one or the other and simply subtract it from 35,000. So this is available. There's only two things that can happen to inventory. It's either sold or still here. So I could compute ending inventory of 14,750, and I could back into cost of goods sold, or I could compute cost of goods sold and back into inventory of just everything left. So that's just really a shortcut way to do it. If you just have a few layers, sometimes it's easier to compute both and then check to make sure they both add up to 35,000. So I'm going to have at the end one entry that's going to force the correct amount into inventory and cost of goods sold. So I record my cost of goods sold of $20,250 and credit inventory. So if you think about a T account of inventory, I started out with 8,000 in it, right there. I purchased 15 and 12, so I add those. I make my journal entry at 20,250, and I'm left with 14,750. So please make sure you practice that. I know watching it, it looks so easy. I often have a lot of students mess up on it. Now let's go to LIFO. LIFO is last in, first out. So again, you don't have to keep them in this order. I simply put them in this order for cost of goods sold and ending inventory. The order is important, but mainly just so I could do it on an Excel spreadsheet. So LIFO is last in, first out. So again, I usually put this 890 first because I need to total up to 890. And I work from the last ones in to the first ones out. So I'm going to put this line first. Again, you don't necessarily have to put it on the bottom. I don't care where you put it. I put them, I just wanted to keep them in the order. So I sold 400 of these, and then I sold 490 of these because I need to add up to 890. It's just a coincidence that the numbers are the same because this number and that number is the same, but I'm selling the $30 ones and then the $25 ones. So again, I do not need this row simply because I just used it for my Excel spreadsheet. So I have 400 at 30 I sold, leaving 0 of those left, of the $30 ones left. I sold 490 of the 600, leaving 110 left. So 490 plus 110 is 600. And I have all 400 of these. So look at what happens to your cost of goods sold. It's 24,250. My ending inventory is 10,750. I can double check my math to see if I'm correct, and indeed those two do add up to the 35,000. I have one entry for debit cost of goods sold, credit inventory for the 24,000. You can see that your inventory does indeed end up at 10,750 because I started with beginning inventory of 8. I have two purchases, 15, 12. I subtract out the cost of goods sold and I'm left with 10,750. My income statement is sales 33,820, cost of goods sold 24,250 for a gross profit of 9750. So we're going to compare these, all three. So in the end, I'm going to show you that sales under all of them are always the same because the selling price doesn't change. However, cost of goods sold does differ because I'm selling different ones. Notice in this particular problem I have inflation. It went from 20 to 25 to 30. So in periods of inflation, LIFO has the highest cost of goods sold. Why? Because it's of the most expensive products or the ones sold. Since it has the highest cost of goods sold, it's going to have the lowest net income. So LIFO is what is often used for tax purposes. So next one is average costing. Average costing is probably in some ways the easiest to do, but the easiest to mess up on also. Under average costing, I simply figure out the average. So look up here at your available. I have 1,400 units that cost a total of $35,000. Do not average the 20, the 25, and the 300. It's a weighted average. because I have way more units at $25 than I do at 30 or 20. So it's going to skew more toward the $25. So I take my total cost divided by my total units. So I take my total cost divided by my total units. I get $25 each. So if you recall from these, I sold $8.90 and I have $5.10 left. So my cost of goods sold is $8.90 times 25. And my ending inventory is $5.10 times 25. I can double check them, that they add up to $35,000. This one you might have a little difference due to rounding, but that's a fine. My entry is to debit cost of goods sold, credit inventory. Notice that I have cost of goods sold for average is always going to be somewhere in between these two. It's not going to be exactly halfway in between these two because I may have different number of units at the different. This one might be exactly simply because I have 400 at the top level and 400 at the bottom level. But most of the time it's just somewhere in between those. But yet sales are the same under all methods. Okay, so notice that gross profit is the highest under FIFO, the lowest under LIFO, and in between for average costing. That only works under periods of inflation. So that is periodic. To sum up periodic, you simply assume all sales happened at the end and back into how many were sold. So again, beginning inventory plus purchases, I have 1,400 available. The problem tells me I have 510 when I went out and counted it. So I have 810 in cost of goods sold. FIFO, I work first in, first out, so top down. LIFO, you work bottom up, so the $30 ones, then the $25 ones. And then under average, I simply take total cost divided by the total units.